Welcome back to our deep dive. It's great to have you with us again. For those just joining us, we're diving into the world of finance.
And in this deep dive, we're taking a look at sources of finance.
Exactly. Last time, we explored those financial statements, balance sheets, income statements, all that good stuff.
Right, the essentials.
Yeah, so now we're moving on to how businesses actually get the money they need. We're going to explore all those sources, from the ones you might already know to some that might be a bit more surprising.
Oh, absolutely. There's a lot more to it than you might think.
It's pretty crucial stuff, right? I mean, whether you're thinking about starting a business or maybe expanding one you already have, or even if you just want to understand how companies get the resources they need.
Absolutely. It's really a fundamental concept for anyone interested in the business world.
Exactly. So today, we'll walk you through all the different ways businesses can get their hands on that much-needed cash. We'll break down each source, we'll look at the pros and cons, and we'll even throw in some examples to make it all crystal clear.
And by the end of this deep dive, you'll be able to not just identify those sources of finance, but you'll also be able to analyze different business situations and see how those sources come into play.
Think about those tricky exam questions, like those 9-mark or 12-mark ones. You'll be well equipped to tackle those after this.
Absolutely. We'll give you those critical thinking tools you need.
Perfect. So let's jump right in. The first big distinction we need to make is between internal and external sources of finance. Could you walk us through the key difference between those?
Sure, happy to. So internal sources of finance, those come from within the business itself.
Okay, makes sense.
Whereas external sources of finance, those come from outside the business.
Gotcha. So like using your own savings versus borrowing from a friend, kind of like that?
Exactly. You've got it.
Okay, I like that analogy.
Yeah.
So let's start with internal sources. What are some common examples?
Well, one of the most common internal sources is something called retained profit.
Retained profit. Okay.
And that's essentially the profit that a business keeps after paying all its expenses and giving out any dividends to shareholders.
So instead of spending all the profit, they kind of tuck some away for a rainy day.
Exactly. They reinvest a portion of it back into the business.
So it's kind of like a squirrel stashing away nuts for winter. They're saving for the future.
That's a great way to put it.
But I'm guessing that also means they might have less money for other things in the short term, right?
That's right. It's a bit of a trade-off. They're choosing growth, but it might mean a little less for things like dividends in the short run. It's about finding that balance.
Makes sense. Prioritizing. So what other internal sources are out there?
Another option is selling assets.
Assets, okay.
That could be anything from unused equipment to vehicles, maybe even property. It's a way to free up cash quickly if a business needs a lump sum.
So, like, if they need money for a specific investment, that makes sense. But wouldn't selling off those things limit what the business can do in the future? What if they need that equipment later on?
Absolutely. You have to be strategic about it. Sometimes selling assets might be the best way to raise capital quickly, but you have to think about those long-term consequences. It's not a decision to take lightly.
Got it. Weighing those pros and cons, just like with retained profits. What about using personal savings to fund a business? Is that an internal source?
That would fall under what we call owner's capital.
Owner's capital, okay.
A lot of entrepreneurs do that, especially when they're just starting out. They invest their own money into their businesses.
So it's commitment, right?
Exactly. And it avoids going into debt right away. But of course, it also puts their personal finances at risk.
It's a big decision, no doubt.
Yeah.
All right, so those are some of the internal sources. Now, what about external sources? Where do businesses turn when they need to raise money from outside sources?
Well, there are quite a few options there, each with its own pluses and minuses. One of the most well-known is a bank loan.
Bank loans, yeah, I've heard of those.
It's pretty straightforward. A business borrows a set amount of money from a bank and then pays it back over time, usually with interest.
So it's like a mortgage, but for your business.
Exactly. That's a good way to think about it. It's a pretty common way to get a larger sum of money.
That sounds pretty convenient, but I'm guessing there are some downsides too, right? Like that interest you mentioned.
You got it. Interest is one of the main drawbacks. The longer you take to pay back the loan, the more interest you end up paying, which can really add up.
Okay, so it's not just free money. There's a cost to it.
Right. And often banks require collateral for loans too.
Collateral, what's that?
It means putting up an asset, like property, to secure the loan. If you can't pay back the loan, the bank can take that asset.
Ah, so there's a certain level of risk involved for the business owner.
Exactly. It's not a decision to be made lightly.
Okay, so you got to be strategic about how much you borrow and how you plan to pay it back. What about those times when a business needs a smaller amount of money just for a little while, like to cover a temporary cash flow issue. Is there something for that?
Yep, that's where an overdraft can come in handy. It's basically an agreement with the bank that lets you withdraw more money than you have in your account, up to a certain limit, of course.
So it's like a safety net in a way.
Exactly. It can be a lifeline for businesses facing those short-term cash flow problems.
But I bet there are some downsides to overdrafts too, right? Don't they usually come with pretty high interest rates?
You're absolutely right. Overdrafts are meant to be used for the short term. The interest rates are high, so if you use them for too long, it can get very expensive.
So use with caution, right? It's a tool, but it's not a long-term solution. Now, what about when a business needs to buy stuff but doesn't have the cash on hand right away? Are there any financing options for that kind of situation?
There is. It's called trade credit.
Trade credit, okay.
It's an arrangement where a business can purchase goods or services now and pay for them later, usually within like 30 to 90 days.
Oh, so it's like an IOU system between businesses.
Exactly. It's super common, and it really helps businesses manage their cash flow, especially if they have tight margins.
Gives them some breathing room before they have to pay up.
Yeah.
That makes sense. But what happens if they can't make that payment on time?
Well, that's when things can get a bit tricky. Late payments can damage relationships with suppliers, maybe even lead to penalties or legal issues. So it's important to use trade credit responsibly and be confident you can meet those payment deadlines.
Right. Maintaining those good relationships is key in business. Speaking of buying things, let's say a business needs a big asset, like a piece of machinery or maybe a fleet of vehicles. Are there financing options for those larger purchases?
There are. For those bigger ticket items, there are two main options: hire purchase and leasing.
Okay, I've heard those terms before, but I always get them mixed up. Can you break them down for me?
Of course. So hire purchase is kind of like an installment plan. You pay for the asset in installments over time. You get to use it while you're paying. And once you've made the final payment, you own it outright.
So it's like renting to own for businesses.
Exactly. That's a great way to put it. It makes those expensive assets more accessible to businesses that might not have a ton of cash up front.
But like everything else, I'm sure there are trade-offs.
Mhm.
What should businesses keep in mind with hire purchase?
Well, you'll usually end up paying more for the asset over time because of interest charges, and you don't technically own it until you've made that last payment. So there might be some limitations on what you can do with it.
Got it. So there's a level of commitment involved. Now, what about leasing? How's that different from a hire purchase?
Leasing is more like renting. You pay a fixed monthly fee to use the asset for a specific period of time, but you never actually own it.
Okay, so it's more about having access to the asset than owning it outright. What are the advantages of that?
Well, one big advantage is that you don't need a huge down payment.
Right? That can be a barrier for some businesses, especially startups.
Exactly. And leasing often includes maintenance costs, which can save you money and hassle.
So it's kind of like a subscription service for business equipment. You get the benefits without the responsibility of ownership. But I'm guessing there are downsides too.
There always are, right? The main one is that you're paying to use it, not to own it. And sometimes there are restrictions on how you can use the asset, depending on the lease agreement.
Makes sense. It all comes down to finding the best fit for your specific needs. All right, so we've covered loans, overdrafts, trade credit, hire purchase, and leasing. Those all seem to be about either borrowing money or delaying payments. Are there any external sources that don't involve debt?
There are, and those are some of the more interesting options, I think. Things like equity investment, grants, and crowdfunding.
Ooh, those sound intriguing, especially equity investment. What's that all about?
Equity investment is when you sell a part of your business to investors in exchange for their capital.
So you're giving up a piece of ownership.
Right, but it's a way to get a good chunk of funding without taking on debt.
I can see the appeal, but giving up ownership is a big deal.
It is. You have to weigh the pros and cons carefully.
So it's like bringing in partners who have a financial stake in your business.
Exactly. And those partners often bring more than just money to the table. They might have expertise, connections, and networks that can really help your business grow.
Okay, I'm starting to see the advantages, but what are some of the downsides? Besides giving up ownership, of course.
Well, one of the big ones is control. When you bring in equity investors, you're giving them a say in how things are run. You might have to compromise on certain aspects of your vision.
Right, so it's a trade-off between access to capital and maintaining control of your business. Now, what about grants? Aren't those usually for nonprofits?
They're common in the nonprofit world, but businesses can get grants too. It's basically a sum of money given by the government, a foundation, or some other organization, often with no repayment required.
Wow, free money. That sounds almost too good to be true. What's the catch?
Well, grants are very competitive. There are usually strict rules about who can apply, and the application process can be pretty intense.
So it's not just about filling out a form and getting a check.
Nope. And even if you get a grant, there are often strings attached, like reporting requirements or limits on how you can use the money.
Gotcha. So it's not just free money, it's about finding the right opportunity and being prepared to jump through some hoops.
Yeah.
What about crowdfunding? That seems to be a popular way to raise money these days.
Crowdfunding has definitely become more mainstream. It's basically raising smaller amounts of money from a lot of people, usually online.
So like harnessing the power of the crowd to support your business.
Exactly. And one of the cool things about crowdfunding is that it's not just about the money, it's about building a community around your business and generating buzz.
That's a great point, engaging with your audience right from the start. But I imagine crowdfunding comes with its own set of challenges, right?
Of course. The biggest one is probably standing out. There are tons of crowdfunding campaigns out there, so you really have to work to get noticed.
So you need a good story, a good strategy. It takes more than just setting up a page on a platform.
You got it. And it's not always successful either. You have to be realistic and know that you might not reach your funding goal.
So it's a bit of a gamble, but it can pay off big time.
Wow, we've covered a lot of ground here. It's amazing to see how many different ways businesses can find the funding they need.
Right.
But it also seems like there's a lot to think about when choosing the right source.
Absolutely. It's not a one-size-fits-all kind of thing.
And that's where our deep dive gets even more interesting. We're going to put all this knowledge into action by looking at a real-world business scenario.
We're going to see how these sources of finance play out in a real-life situation.
I love a good case study. Tell me more. Well, imagine a bustling little coffee shop called BrewBliss. BrewBliss, they're doing really well, got this loyal customer base, and they're ready to expand.
That's awesome. So what's the plan?
The owner, Sally, she wants to get a coffee van.
Oh, cool. Like a mobile coffee shop.
Yeah, exactly. Take it to festivals, events, all that. She's done her research, and she figures she needs about 50,000 pounds to make this happen.
Okay, so she's got a vision, she's got a plan, but now she needs the money. So where does she start?
Well, she's already been looking into her options, and she's kind of narrowed it down to two main contenders.
Okay, what are they?
A bank loan or an equity investment.
Ooh, those are pretty different approaches, right?
Yeah, for sure.
I mean, with a loan, she stays in total control, but with an investment, she's got to share ownership. Tough choice.
Exactly. That's where the real analysis comes in. We got to look at the specifics, weigh the pros and cons, see what makes sense for Sally and BrewBliss.
All right, let's start with the bank loan. What are we talking about here?
So she's been offered a loan for the full 50,000 pounds, 10% annual interest rate over 5 years.
10%. Okay. And that works out too.
Monthly repayments of 1,065 pounds, $45.
Wow, that's a pretty hefty payment each month. I can see how that could impact her cash flow, especially when she's just starting out with a van.
Definitely something to think about. And there's another thing with bank loans, they usually require collateral.
Oh, right, collateral. We talked about that earlier. So what would Sally have to put up?
Probably her shop or some other asset that's worth a decent amount. It's a risk, for sure.
Yeah, big time. If things don't work out with the coffee van, she could lose her shop. That's a lot to put on the line.
Exactly. And even if the van is a huge success, those monthly payments are still there every month.
Rain or shine.
No matter what. So she needs to be sure she can handle that, even if there are slow seasons or unexpected costs pop up.
Okay, so the bank loan, it's straightforward, but it comes with some serious commitments and risks. Now, let's talk about that equity investment. What does that look like for Sally?
Well, a venture capital firm, they're interested in BrewBliss. They're willing to put up the whole 50,000 pounds.
Wow, the whole amount. But what's the catch?
They want 20% ownership in exchange, plus a share of the profits.
20%, that's a big chunk of the business.
It is. So it's not just about the money. There are other things to consider, too.
Like what?
Well, venture capitalists, they're not just silent partners. They bring a lot of experience to the table. They have connections, and they often get involved in the business decisions.
So it's like gaining a partner who knows the ropes. That could be huge for Sally, especially since this is a new venture for her.
Yeah, that support can be really valuable. And unlike a loan, there are no fixed repayments with an equity investment.
Oh, that's a big plus. Takes some of the pressure off, for sure. But I bet there are some downsides too, right? What are the things Sally needs to be careful about?
Control. That's the big one.
Right. Giving up that 20%.
Exactly. She'd be sharing control with those investors. They'd have a say in how things are run. And that might not be something every business owner is comfortable with.
Yeah, I get that. It's about finding that balance, getting the resources you need, but also holding on to your vision for the business. And of course, you'd be sharing the profits too.
Right. That's a factor as well. If Sally thinks the venture capital firm's expertise and support are worth more than that 20% ownership, then this could be a good fit.
But if she's fiercely independent and really wants to call all the shots, then a loan might be better, even with the risks and the payments.
Exactly.
It's a tough call. Financial security versus independence. There's no easy answer. It all depends on Sally's priorities and how much risk she's willing to take.
Right. Every entrepreneur is different. And to help make this decision a bit clearer, we're going to use a tool called PLC.
Keel LC, I think I've heard of that. What is it again?
It stands for Point, Evidence, Explanation, Link, and Conclusion. It's a really useful framework for analyzing business situations.
Okay, that rings a bell. But how does PLC help Sally decide about her financing?
Well, we can use it to break down each option step by step. We look at the evidence, explain what it means, and then we can come to a conclusion about which option is best for BrewBliss.
Okay, I like that. A systematic approach takes the emotion out of it and lets us look at the facts. All right, I'm ready to dive into PLC. Let's start with the bank loan. What's the first point?
The first point is just stating the option. So a bank loan for £50,000. Then we look at the evidence, which is the specific terms of the loan. 10% interest, 5 years, monthly payments of £1,065.45.
Okay, that sets the scene. So what's the explanation? How do these numbers impact BrewBliss and what Sally wants to achieve?
Well, the main thing is the loan gives her access to the money right away so she can get that van and equipment without waiting. And the fixed monthly payments, that can make budgeting easier.
Right, knowing exactly what you owe each month, that's helpful. But those fixed payments could also be a problem, right? Well, what if things slow down or some unexpected cost pops up?
Yeah, that's a good point. As long as business is good, the payments are manageable, but if things get tough, they could become a real burden.
And don't forget about the collateral. If BrewBliss can't make those payments, Sally could lose her shop.
Exactly. So the bank loan, it gives structure. Sally keeps ownership of BrewBliss, but there's also a lot of risk involved.
Okay, so we've got the point, the evidence, the explanation, and how it all connects to Sally's situation. What's the conclusion for this option?
The conclusion is the bank loan is a clear path to getting the money, but it comes with a high level of financial risk. There's the potential for Sally to lose her personal assets if the venture doesn't succeed.
All right, that's a pretty clear assessment of the bank loan. Now let's switch gears and focus on the equity investment option. Let's run it through the same PLC framework. What's the first point we need to consider?
Okay, so we've looked at the bank loan using that PLC method pretty thoroughly. Now let's turn our attention to the equity investment option and run through that same process. What's the first point for this one? Just like before, we start by stating the option. So in this case, it's an equity investment of £50,000. And the evidence is the proposed ownership, that 20% stake the venture capital firm would get in BrewBliss.
Got it. That lays the groundwork. Now let's move on to the explanation. How does this impact BrewBliss and Sally's plans for expansion?
One of the biggest advantages here is that Sally gets the £50,000 without those fixed monthly payments.
Right, no loan repayments. That's a big difference.
Exactly. And that kind of flexibility can be a game changer, especially in those early stages when cash flow can be a bit all over the place.
Makes sense while she's getting the coffee van business up and running. And we can't forget about the expertise and support she could get from these investors.
Absolutely. Venture capital firms, they've seen it all. They have tons of experience. They know how to help businesses grow and navigate those tricky situations.
So it's not just about the money, it's about having those experienced people in your corner.
Exactly. They're not just giving money, they're invested in seeing BrewBliss succeed. And that often means valuable advice, connections, access to networks that Sally might not have on her own.
So it's like a two-for-one deal, financial capital and human capital. Sounds pretty powerful. But like with everything else, there have to be some downsides. What are those with equity investment?
The main one, and we've touched on this before, is control.
Sharing control with investors.
Yeah, equity investment gives you that flexibility, that support, but it also means sharing profits and, crucially, control. Sally would be giving up some of her decision-making power.
Right, she'd have to be okay with not calling all the shots anymore.
And for some entrepreneurs, that's a deal breaker. It's about finding that balance. What's most important to you?
Access to resources or maintaining that autonomy. It's a tough decision. So what's the conclusion we can draw about equity investment for Sally and BrewBliss?
The conclusion here is that equity investment, it's a strong alternative to a bank loan. It offers flexibility, it offers expertise, it can really help BrewBliss grow quickly, but it comes at the cost of sharing ownership, profits, and control.
Okay, so we've walked through both options with this PLC framework. We've looked at all the angles, the evidence, the implications, and how it all relates back to Sally's goals. Now for the big question. Which option seems like the better fit for her?
That is the million-dollar question, isn't it? If we're going just by our PLC analysis, I think we lean towards the bank loan, at least for now.
Really, I was leaning towards the equity investment, with all that flexibility and support. What makes you favor the loan?
Well, that flexibility and support are great, but don't forget, BrewBliss is already doing well. They've got loyal customers, people love their coffee, they've got a solid brand.
So they've got a good foundation already.
Exactly. And with a loan, even though there are risks, Sally gets to keep full ownership and control of her business.
So in this case, independence trumps those other perks.
It seems that way. It all boils down to what Sally envisions for BrewBliss. If she really wants to stay in charge and reap the full benefits of her hard work, then the loan makes sense.
Okay, so she can chase that coffee van dream without giving up control of her business. It does sound like a win-win as long as she can handle those loan payments.
Absolutely. And what this really highlights is that there's no right answer when it comes to sources of finance. It all depends on the business, the goals, the owner's vision.
So what's best for one business might not be best for another. Makes sense.
Exactly. And that's why understanding these sources of finance is so crucial. It gives entrepreneurs like Sally the power to make those smart decisions that align with their long-term goals.
I love that. Well, I think that wraps up our deep dive into the world of sources of finance. We've covered a lot of ground today. Hopefully, you've all learned a thing or two, and maybe you'll even be able to use this in those tricky exam questions.
And if you're looking for more guidance on business strategy and analysis, make sure you check out PLC Strategy.
And a big thank you to Google LM Notebook for the audio dialogue in this deep dive. Thanks for joining us, everyone. Keep learning, stay curious, and may all your business ventures be as successful as BrewBliss.
Cheers to that.